Hi, welcome to Money Mastery with Dee Dee. Today's topic is I own the company or I am the company. How do I pay myself? And this is a kind of complex question. You think it'd be simple. If you get a W-2 from your employer, getting paid a wage was always a really simple thing. But once you own the company or you are the company, there's a lot of layers to this. And the first layer is always, what is your structure? So if you own a company and it's just you, probably you're an LLC. Depends on how expensive LLCs are in your state. But if it's just you, you are likely going to be taxed as a sole proprietor. That's going to be on Schedule C. But if there's more than one person, it's, again, another layer of complexity. Multi-member companies can choose different structures. You can be a partnership. You can be a sub-S corporation, and above that, you can actually have an LLC as well. We're going to talk about LLCs in another video, but basically an LLC is a limited liability company that protects your personal assets from claims made against your company. So, for example, you own a rental house, you put the rental house itself inside the LLC, somebody slips and falls, they can only sue for what's in that LLC, which is the rental house, not any of your other assets. So that extends to any kind of services you might be offering. Most folks who are self-employed or own small companies want the benefit of either a corporation or an LLC. So with that said, if you have an LLC with multiple members, it can be taxed in a couple of different ways. It can be taxed as two Schedule Cs. If you're married to your business partner, you actually have the ability to just simply put it on two Schedule Cs in your 1040. Really easy. It was a great adjustment made to the law a few years ago. Glad we have that. If it's a multiple member and they're not your spouse, then you have a choice. You can be taxed as a partnership or as a sub-S corporation. And we're going to come to some nuances with that in a minute. Because really what you want to know is, how the heck do I pay myself? I've got my YouTube channel up and running. It's got money coming in. If I take money out, am I going to get taxed on that money that gets taken out? How much is it going to be down the road? So we're going to start with an example. You've got a company, you're mowing lawns, you're a YouTube star, whatever it is you might do. And over the course of the year, you expect you're going to receive an income, $100,000. Okay, nice round numbers, making my life easy. Hopefully you can adjust it for your situation. And further assume that related to that, there's going to be $10,000 in expenses. Maybe you had to buy new mowers or gasoline or new video equipment, whatever it may be. So that means your net income for your company is $90,000. Well, what happens then? Do I just pull all that $90,000 into my household and consider that income? Not so fast. That could get you in behind the eight ball when it comes to tax time. First thing we have to look at is self-employment tax. Now, this is a tax you were familiar with on a W-2. It was FICA and Medicare of 7.65. Well, now that you are both the employee and the boss rolled into one, you get to pay both halves of that, which is 15.3%, commonly referred to as self-employment tax. Now, I get that feels really high. Those of us who have companies agree with you, but it is what it is. So on that $90,000, the first tax you need to calculate is the self-employment tax. And our example of $90,000 self-employment tax is just a hair under $14,000. Yowza. So that's the first one we have to make sure that we're saving money for. After that, we're going to take the net income from there, which is a little bit over $60,000, and it's going to flow through to your tax return. And remember, we're just trying to make an estimate so we know how to pay ourselves later, but I have to walk you through this complexity so that we can come up with a couple of percentages to use as we go through the year. If you're single, your income is going to be, like I say, a little over $60,000. That means you're going to have income at the 10, the 12, and the 22% tax rates, because we have graduated tax rates. In this particular case, it averages out to around $10,000, which is 15% on your net income. That's on the $90,000. And remember, you also need to pay state income tax. For illustration purposes, we're just going to go with 5%. Different states have different rates. Some have 0, some go even higher. So if you add up all those taxes for a single person, unmarried person, they total 30% of your net income. So that $90,000 of net income, 30% needs to go toward taxes. So in reality, what does that mean for you? You're a single person, you've made income in this range. How do you handle this? Well, the good news is as you move money from your company into your household checking account, that is a non-taxable event because the taxes happen before the money makes it even into your pocket as far as the reporting for it on the books. But it does mean for every $10 that your company earns, $3 needs to be set aside in anticipation of these three kinds of taxes. So once you understand how much your company is going to bring in, reasonable projection, we can adjust for this throughout the year. You divide that up by how much your family is going to need to run on, say on that $100,000, and 10 is going to expenses, 30,000 is going to taxes. That leaves $60,000 left for you to choose what to do. If your household can live on less than that, you take less out of the company. If it needs all of it, you take it all out. It depends on where you are in your growth cycle, depends on how big your mortgage and other obligations that you have. But once you have those percentages, you can say, all right, I can take, say, $60,000 a year over the course of a year, divvy that up. I can withdraw $5,000 a month from my company and move it from the company to my household, leaving the rest of the money ready to pay taxes and be okay. Now, what does that look like? Well, this is where we come into the bookkeeping. You need to keep track of this because it's not a taxable event, but you need to keep track of where the money's flowing. You're going to debit and credit owner's equity and owner's draw. If you're working with a bookkeeper, they'll help you out with that. But if you just keep a ledger of withdrawals that you've made, that's going to help when you do your taxes at the end of the year. When can you take this? That's the cool thing about being self-employed. You can schedule the disbursements at whatever point in time that work for you. Lots of families can manage their budgets in a monthly way because most of their bills are month loaded, either at the beginning or the end of the month. Other people have been used to getting paid every 2 weeks or twice a month. If that's what you're used to, that's what you schedule it out. I think it's really important to say, all right, and how much can I take out just to keep the family going? No fancy stuff, and set that on auto pay. It's going to reduce stress for you in so many ways. And if you happen to be married, much less stress for the family unit if there's a predictable flow of money. That does mean if it's less than your max amount that you're going to accumulate money in the company, which is terrific. If you're accumulating money in the company, you have additional choices. You might want to invest in the company. You might want to add to your retirement account, or you might just hold it there for a rainy day in case you need it elsewhere. And I'm sure there's dozens of other ideas. But the idea is be able to project what your income is, do a back of the envelope tax calculation so you know how much to reserve, and then set up a schedule moving that money from your company into your household. Now, if you're married under this scenario, the numbers change a little bit. Instead of 30%, it's only 25%, but it's a very similar calculation. If you're married, though, you need to run that back of the envelope calculation, including whatever income your spouse may have. So be careful as you run those numbers to understand what's going on there. And if your spouse is covering the household expenses, the transfers might not be as frequent, or they might not even happen at all if you're in early days of starting a company and needing to reinvest a lot of money. So that's what happens when things are flowing through as a Schedule C individual or even married. Now, I mentioned there's two other choices. You could be choosing to be taxed as a partnership because you have a partner who is not someone married to you. In this case, the calculation for taxes is fairly similar, but as you take distributions out of that partnership, it affects how much each owner owns. So if you each put in the same amount of money, but one person is drawing a lot of money out, that changes the relative ownership percentages. Partnerships I find to be one of the most complicated accounting types around. So if you're choosing to be taxed as a partnership, absolutely get in touch with a good CPA to help you keep things on track. And then the final choice is a sub S. Now this is more complicated than the other two because it's a separate entity. Now it is still a flow-through entity and the income is going to be taxed on your 1040. But in a sub S, you can pay yourself in two ways, not just one. You can pay yourself W-2 wages, and then whatever profit is left at the end of the year, you can distribute as a dividend and have it be paid. Actually, the distribution, like I said, is not taxable, but what's left over is taxed to you, not, and will be exempt from that self-employment tax. Under the sub S structure, you want to make sure that you're paying yourself an appropriate, fair market wage. You don't want to, come in, say you're a CPA and pay yourself $10,000 a year. That's not reasonable. So you need to find out what's reasonable. Look on monster.com, see what somebody like you would be earning. That's the number to start with. And then if there's extra beyond that, that's company profits as opposed to compensation for sweat of the brow. And those two get taxed differently. Now, all of these types of companies we've talked about so far are flow-through entities. And right now, there's a current tax law that allows for a 20% deduction off the top before you calculate your taxes. That's the qualified business income tax credit. We have a separate video on that if you want to learn more. But that's certainly an advantage right now for folks who run their own small businesses or who are their own small businesses. I know this is complicated. There's lots of layers to this. If you've got more questions, absolutely reach out to us. We'd love to help you out. We love helping folks who've got these small businesses make sure they get started on the right foot and feel really empowered and excited about where they're going. Thanks for joining us today. This has been Dee Dee Jones with Innovative Financial, helping you make the best of your financial decisions. Have a great day.